If you ever seen a candle shoot up and down in a quick explosive move and then wonder why the market later comes back to that same area, you've just seen imbalance in action. It's one of the most overlooked yet powerful clues in institutional trading because it reveals where price moved too fast, where inefficiency was left behind, and where smart money is likely to return. In simple terms, an imbalance happens when the market moves so aggressively in one direction that it doesn't allow buyers and sellers to trade evenly. There's a sudden surge of orders from one side, too many buyers or too many sellers, and price rushes away, leaving behind an area with little to no trading activity. In smart money concepts, that untraded space is also called a fair value gap, or FVG. It represents inefficiency, or lack of balance between buying and selling. The market always seeks equilibrium, so it tends to come back later to fill that gap, allowing both sides to trade fairly again. To understand it better, imagine a grocery store. Normally, people buy and sell items steadily. But one day, a huge crowd storms in to buy everything at once. The shelves empty in minutes, leaving a gap in the supply. Later, the store restocks, bringing the shelves back to balance. That's exactly how imbalance works in the market. When institutions execute large buy or sell orders, they often cause these rapid displacements in price. They push through multiple levels without resistance, creating an imbalance between buying and selling pressure. Once that move stabilizes, the market tends to retrace back into that zone to rebalance liquidity. That's why you'll often hear traders say, the market always fills its gaps. It's no superstition, it's simply efficiency. The market doesn't like unfinished business. Now, let's look at what an imbalance really looks like. You can spot it easily between 3 consecutive candles. If you have a strong bullish candle in the middle and the high of the first bearish candle doesn't overlap the low of the third candle, that empty space is an upward imbalance or bullish fair value gap. If the opposite happens, a strong bearish candle creates a gap that the following bullish candle doesn't reach. That's a downward imbalance. When price leaves an imbalance behind, it tells you that smart money pushed the market aggressively, probably to fill orders or grab liquidity. But they'll often come back to those same zones later to rebalance price before continuing the main move. Here's where it gets interesting. Not all imbalance gets filled right away. Some take hours, days, or even weeks. But statistically, most of them eventually do, because that's how markets maintain fairness. In trading terms, that means that those imbalanced areas become magnet zones, areas where price is attracted to. When traders combine imbalance with other tools like order blocks, supply or demand zones, or structure breaks, they can pinpoint precise entries with low risk. For example, if price sweeps liquidity, then retraces into a fair value gap that overlaps an order block, that's a high probability trade setup. Let's go through a real example to make this concrete. Imagine the market has been trending upward, forming higher highs. Suddenly, a large bullish candle pushes price up sharply, leaving a visible gap between wicks. That's your imbalance, you market. Later, price retraces back down, partially fills that gap, and shows a bullish reaction, low wicks or a strong rejection candle. That's where smart money likely steps back into continuing the trend. In a bearish scenario, it's the same logic reversed. Price drops sharply, leaving a clean gap between candles. That area becomes a potential sell zone. When price retraces upward into it, that's where institutions might re-enter short positions to drive the market lower again. These patterns appear across all time frames. On 1 minute chart, an imbalance might fill within minutes. On a daily chart, it might take weeks. The larger the time frame, the more significant the imbalance is. That's why institutional traders track them across multiple scales, because those zones reveal where unfinished business lies in the market. Another important thing to remember is that price doesn't always fill an imbalance completely. Sometimes it only taps the top or bottom edge and moves away again. This partial fill is still valid. Is the market briefly rebalancing before continuing? Now, let's connect imbalance to structure. Most imbalances form right after a break of structure or BOS, or a change of character. Why is this? Because those moments signals a shift in momentum, and institutions need to move large amounts of capital fast. That rapid movement leaves inefficiency behind. When you see imbalance forming after a break of structure, it's like a footprint confirming institutional intention. Imbalances can also help traders forecast where price is heading next. If price leaves an unfilled gap above, there is a high chance it will revisit that area later. If an imbalance sits below, it might act as a short-term target for a retracement. This perspective helps traders anticipate rather than react. Let's use an analogy to make it crystal clear. Imagine throwing a ball high into the air. It shoots up quickly, but gravity always pulls it back before it continues moving naturally. In trading, imbalance is that pull of gravity. Price can't stay too far from fair value forever. It has to come back to restore balance. Understanding imbalance helps you see the logic behind every impulsive move. It tells you not just where the market went, but why it's likely to come back. It reveals the unfinished areas on the chart where price still owes a visit. So, in simple words, imbalance is the market's way of saying, wait, we moved too fast, let's go back and make it fair. Once you start spotting those inefficiencies, you will notice that every explosive move leaves behind a clue for the next one. So, the next time you see price shooting off without looking back, don't chase it. Mark the gap, wait patiently, and let the market come to you, because sooner or later it always does.